On one hand, the US economy could be heading towards a recession. The November FOMC minutes stated that it was basically the base case, with the staff continuing to judge that the risks of the baseline projection for real activity was skewed to the downside and viewed the possibility that the economy would enter a recession sometime over the next year as almost as likely as the baseline. Slowing business activity, the cost of living, falling export demand, higher debt repayments all point to the Fed needing to slow the path of rates. However, last Friday's strong jobs print suggests that the Fed may need to hike more aggressively and potentially go higher than 5% next year. You can see that the headline was above market's maximum expectations of 200,000 at 263,000, and the prior report was revised higher. Furthermore, if you take a look at the wages, you can see that the wage hourly earnings is up 5.1%, well above the market's maximum expectation of 4.7%, and the prior was revised higher. All of that suggests that potentially the Fed is looking at a wage price spiral underway that will have to be handled with higher interest rates, potentially. However, on the other hand, if there's a US recession, if we have seen the peak in US rates, and a falling US dollar, that would all support precious metals like gold and silver. So silver's seasonals could really be worth investigating. Over the last 25 years, silver has a strong bias for strength between the 16th of December and the 28th of February, with a gaining pattern over 19 times in those 25 years, increasing and only losing value 6 times. So, is that an investigation that's worth taking place to see exactly what the Fed's policy will be and whether that will support silver prices higher in line with its seasonal patterns? Now, major trade risks. There are clearly two-way trade risks here, as much will depend on the path of US rates, the US dollar, Federal Reserve policy, and inflation over the coming days and weeks. Remember, don't just trade it, but season exit.